Being here. Let's start off with the economy and let's talk about what is happening here. And maybe you can bring us up to date on how well the economy is doing. I mean, we have Trump out there pushing tariffs. We have the omnibus spending bill at $1.3 trillion. The Fed is raising rates. Is the economy doing a lot better today?
Well, first of all, let's just look at growth. Q1 GDP growth came in at 2.3%. So that's pretty much the same tepid, anemic growth rate we've seen since 2010. So there is no big growth spurt coming in the second half. You know, the mantra from Wall Street is just hang on to the second half recovery. You know, the first quarter is always weak and the second quarter is going to be great. And that's been the same BS they've spouted out to investors for going on 8 years now. It's not happening. The growth rate is 2.3%, and it's going to go lower, and I'll explain why. First of all, let's talk a little bit more about growth before I explain why it's headed even lower. If you look at the housing market, the real estate sector, one thing is for sure is that you cannot have a booming, healthy economy if you don't have a healthy real estate sector. As housing goes, so goes the economy. That's just pretty much a fact. It's been that way forever since there's been homes. Well, year over year, mortgage applications, this is from the Mortgage Banking Association, not from Michael Pinto, fell 6% year on year, not month on month or quarter over quarter. Year on year, the applications to purchase a mortgage, most of which are going to be denied, or many of which, I don't want to be hyperbolic, but many of which will be denied because people don't qualify for homes, given the fact that interest rates are rising and the home prices are still rising too. So just the mere applications are down 6%. So no, we do not have a very robust economy at all. We are not in a recession yet. We've been teetering on one for the past 9 years, barely growing at all. But that growth rate is soon going to tip over into a recession because over and above, forget about what Trump's done with his deficit funded tax cuts. We have a condition where the bond market, the bond bubble, which I predicted would collapse in 2013, is no longer predictive. It is now in the process of happening. The bond market is collapsing, and it's especially collapsing here in the United States, the world's reserve currency. If you look at LIBOR, if you look at the 10-year Treasury, it's gone from 1.3% to 3%. And by the way, that LIBOR is not just some ethereal, esoteric, arcane rate that no one cares about. That rate, the LIBOR rate, is the function behind about $370 trillion worth of loans and derivatives, 0.3 to 2.3 on LIBOR. But anyway, LIBOR has gone much, much higher. It's rising dramatically, and the cost of loans and derivatives that back $370 trillion worth of these kind of weapons of mass destruction, as Warren Buffett calls them, that rate is soaring. And as the bond bubble collapses, so will global economies. And that's exactly what I predict is going to happen around the end of this year, towards the October, November timeframe, as issuances from the Treasury Department rise to $1.8 trillion. That's $1.2 trillion in deficits plus $600 billion worth on an annual rate of sells from the Federal Reserve. That is why the anemic growth rate of the economy, which is just about a little bit over 2%, which has been stuck in that range for going back to since 2010, so for 8 years now, is actually going to roll over very, very soon.
The Fed is out there, and you mentioned the bond collapse, and you predicted this in your book, and we're feeling it right now. We're seeing it happen right in front of us. But the Fed is out there, and they're saying, well, you know, the yield curve, not that big of a deal. It doesn't really mean that much. Is the yield curve important?
It's very important. So every time the yield curve has inverted or flattened out and inverted, and it's done so many times throughout history, the past 9 times that has happened, it's led to a recession. So 9 out of 9 is pretty high batting average there. So about 6 months to a year after the yield curve inverts, we have a recession. And I don't think it's going to be anywhere near a year this time, or even 6 months, because when the yield curve usually has inverted in the past, it's been in the context of a Fed that was aggressively raising rates to try to slow down an economy that was running full speed ahead. This time around, the Federal Reserve is raising rates not because we have a runaway economy, but because they just have to get far enough off zero to give them room to lower rates once the next recession becomes manifest. So they're in a panic there over there at the Federal Reserve, and Mr. Powell and the rest of his ilk is trying to get the Fed funds rate to 3% before the economy collapses. Now, don't forget, in 2008, the Fed funds rate was 5.25%. So the Fed could lower rates by 525 basis points, and they could go into QE very readily because the Fed's balance sheet was only $800 billion. Well, now if the recession was to manifest in the next few quarters, as I predict it will, well, the Fed's only going to be around 2.25 on the Fed funds rate. So they can only take rates down to 2.25. So they have less than half the bullets in the chamber to reduce borrowing costs to get asset prices back into a bubble, which is what they want to do to protect banks' assets. Also, the Fed's balance sheet is no longer $800 billion; it's $4.3 trillion. So they have less room to just go around and say, "Hey, we have gone from a rate hiking regime and a reverse QE regime," which I talked about, that reverse QE, $50 billion per month of mortgage-backed security and Treasury sales. We're going to go from raising rates and reverse QE to lowering rates to then going back into QE and adding to our balance sheet, which is well over $4 trillion. That's a trenchant epiphany on the part of the Federal Reserve. They're going to be very slow to do that. What's going to make them move in that direction is a plunge in stock prices, which I predict is going to happen also by the end of this year. And when stock prices drop, they don't, they say they take the stairway up and the window or the elevator down. Well, the stock market is going to drop 20 or 30% in a matter of a few weeks. And then the Fed's going to say, well, we're going to stop raising rates. And then the stock's going to drop another few percentage points. And then the Fed's going to say, well, maybe we'll stop quantitative tightening, and the stock market is going to be dropping this whole time. So in aggregate, the stock market might lose 50% plus of its value before the Fed gets around to saying, hey, we better get back into quantitative easing. But that's not an automatic valve that you can turn on and off where you think, well, as soon as you go back to QE, the stock market turns around and the economy turns around. The damage is going to be already done, Dave. So what I'm trying to say is get ready for a depression like we've never seen before, and get ready for a stock market collapse like we've never seen before. And then on the other side of that, deflationary depression, interest rates will explode higher, and you're going to have a Federal Reserve that's going to be resorting to things like universal basic income, which is a form of helicopter money, NIRP, negative interest rates, and the banishment of cash, physical cash. That's the kind of dynamics we're looking at the next time we go into a recession. And by the way, governments and central banks haven't outlawed the economic cycle. We are going to have another recession. We are going to have another depression. And the reason why I'm so convinced of that is because since the governments and central banks around the world taken interest rates to 0% and below and left them there for 8 years, what they've done is actually pushed a tremendous amount of debt onto the economy. In fact, total debt now is global debt, 330% of GDP, $240 trillion. That's up $70 trillion since a decade ago. So the leverage ratio is way up. The nominal amount of debt has skyrocketed. So you have record low interest rates, a bond bubble collapse, on top of record debt, which is going to be, which is extent in the context of record asset prices, a record stock market as a percentage of the economy, 150%. So if you look at the market cap of equities as a percentage of the underlying economy, that is 150%. That has never before happened in history. The highest rate before that was in March of 2000, and that was 148% debt, 148% debt to GDP. That's the scenario that they have. Don't listen to CNBC. Turn off the channel. They're never going to talk about the fact that central banks have pushed the entire fixed income spectrum into a huge bubble. that engendered records amount of debt and pushed asset prices and real estate prices into record high territory. What a dangerous combination. That's the truth.
So when this does happen and we're in this recession / depression and the central bank comes out and, they do the helicopter money, like you said, the universal basic income, they lower the interest rates. Is this really going to help the economy at all? I mean, is this really going to bring it back?
I don't think so. I think it's going to eventually, the dynamics between deflation and inflation are going to be so trenchant and so dynamic like you've never seen before. So the violent swings between both those conditions are going to be earth-shattering, in my opinion. But the fact that you're able to rescue an economy from a deflationary depression, which, by the way, is a very healthy thing to occur. It's the medicine that's going to be required or would be required to restore the economy back to viable health and a viable condition. What's going to happen instead is we're going to generate a whole lot of inflation. Because if you think about universal basic income or helicopter money, it goes around the banking system. So the Fed prints money, and instead of buying assets at the primary dealers, they circumvent the primary dealers in the banking system and go directly to the citizenry, paying people to become latent and fallow. So you're going to get a check in the mail, and it's going to be inflation adjusted, and you're going to collect your check, and you're going to not be productive. They have all these excuses for it. They call it, the automation of the economy, AI, and all this stuff will render people into useless masses of goo that can't do anything. So the government's got to take care of you, which also provides the government a ready and willing voting class. But you're paying people to not be productive, and you dramatically increase the broad money supply. At the same time, the productive capacity of the economy becomes eviscerated. That's a recipe for hyperinflation. That's not what I would consider a viable long-term solve for the economy. So, like I said before, deflation, depression, and then hyperinflation and depression. That's what I think we're headed until these people who run the global economy assent to the notion that interest rates and tax rates and inflation rates and currencies should be a function of the free market. A function of the free market, not under the control of the IMF and central bankers and governments. So where's the free market any longer? You see, these people not too long ago, maybe around 1987, late 80s, decided that recessions had to be abrogated, annulled, repealed, canceled. We weren't going to allow the economy to ever undergo any more recessions, ever again. And by doing so, they've gradually usurped control of the entire free market function. There is no more free markets in equities. You look at Japan, owns over half of the ETF market. If you look at the bond market, Japan owns every JGB that's printed. The European Central Bank has taken the German Bund 10 years down to 0.5%. In the U.S. Treasury market, we're sitting at a Treasury that's almost 3%. So, there is no free markets anymore. They don't exist. The governments own everything. And when governments own things, they tend to blow up.
So this is going to be a global depression, not just here in the United States.
Absolutely, 100%. It's probably look. Let's just talk about Argentina for a second. So not too long ago, and by the way, the nation of Argentina is a serial defaulter. Throughout its history, it defaults on its debt. But because central banks have taken interest rates so low that they have no choice, the investors have no choice but to go out along the risk curve and search for yield, they actually thought it was a good idea in Argentina to float a 100-year bond and back it in dollars at 8%. And at 8%, this issue was oversubscribed. People around the world wanted this bond. Argentina debt, 8%, sounded great. Well, because it's a dollar-based bond, as our Federal Reserve started raising interest rates, Argentina couldn't do so because they had a weak economy, relatively weak economy. And that gap between interest rates in the United States and in Argentina started to widen and caused the dollar to rise dramatically against the Argentine peso. And when you have debt denominated in dollars, a depreciating currency makes that debt harder to pay back. And so what happened is that a country like Argentina had a choice, a very dire choice, very daunting choice. They could either allow their currency to depreciate and plummet, which would cause hyperinflation and destroy the economy and make that debt payment impossible for their dollar-based bonds, or dramatically raise interest rates to defend their currency, which would in turn destroy their economy and make it impossible to pay back the bonds, and go to the IMF for another bailout and to restructure or default on these bonds. Well, Argentina decided to raise interest rates. They took interest rates to 40% recently, 40% to defend the value of their currency. Of course, their economy is imploding, and that means that guess what? They recently went to the IMF and Madame Lagarde and asked for a bailout. This is one example, the currency chaos that's going to happen, that's beginning to manifest and metastasize across the globe, because when you take interest rates around the world and push them to zero or below for 8 years, bad things happen, and they're already starting to occur.
Do you think when we go into this depression scenario, do you think a lot of the countries are going to lose faith in the dollar? And do you think we'll be moving into some other type of reserve currency?
Well, I mean, you know, they're not going to lose faith in the dollar and run into the yen, and they're certainly not going to go to the euro, and they're probably not going to lose faith in the dollar and run to the Argentine peso. What they will do is they will lose faith in fiat currencies across the globe and run into gold and silver and platinum. Precious metals, especially gold, which have been considered money, real and honest money, for thousands of years, will once again come to the fore. And hopefully, after this chaos consummates, we will return to money being backed by gold. And that, my friend, will be very beneficial for everybody, because you'll have no trenchant wealth gap. There'll be no big gap between the very rich and the working poor. The financialization of the globe will go away. You'll have honest money, which provides for stable currency, stable tax rates, stable inflation, no bubbles. That's what I'm hoping for. That's what we really need. Limit and fetter the monetary base to the mine supply of gold, which is commensurate with productivity and the increase in population. So the money supply grows with the economy, and there's no more bubbles. That's what we need. That's my hope and prayer.
So do you think, I mean, you mentioned gold, China and Russia, I mean, they've been purchasing gold left and right here, and they're just continually purchasing. We don't hear too much about the United States purchasing gold, but countries, India and others, are actually repatriating some gold. We heard Germany has done that, and other countries are also doing that. Do they know something?
Well, like I said, I like to say Wall Street runs on insider information. These countries understand viscerally that the next global depression is coming quickly, and they are seeking to back their currencies in hard money, China and Russia. They're also looking to get away from the dollar hegemony by creating an exchange for energy and oil backed by the yuan would be backed by a commodity, hard commodity like gold, or a soft commodity like energy. So the dollar's dominance is going to go down in the world, but I do not believe that it's going to be most manifested against other currencies. The collapse of fiat currencies around the world and economies around the world will be most evident against the price of gold.
And what do you think gold will go up to?
In nominal terms, I expect it to be all-time highs by the end of 2019. So north of 2,000 an ounce, and certainly $40 for silver, $40 to $60 for silver.
How long, when we're in this depression, how long will this be for? I mean, will it be like a month or 2 months? What should people expect?
I can assure you I'm not that good, Dave, to tell you exactly how long the depression will be. I know one thing, that if you are a buy and hold investor I specialize in actively managing money. If you are a buy and hold investor, you're going to get crushed. Once again, for the third time since the year 2000. What I'm suggesting is that we are going to have a deflationary depression first. It's going to last for several months at a minimum. It's going to bring asset values down to half of their value. And then on the backside of that, it will take some time, but we're going to have inflation like we've never seen before. Because just think about this. If I'm correct, and I think I am, obviously, if we have a stock market that's down 50%, there won't be a solvent pension plan around in the world. If we have a global equity market collapse, which I'm predicting, there won't be a solvent pension plan, public or private, in the world. And I'm not even using much of an exaggeration there at all. I don't think I'm being hyperbolic. So what are they going to do? Tell people we're going to allow people in power having a responsibility to keep people fed and the economy running. So they're going to try everything before when the hyperinflation occurs, that's when they have to give up. Then they understand what they've done. There's nothing they can do but except let it collapse. But they're going to try everything first, and they are right now floating the ideas of universal basic income. People in power are writing books about it. They're talking about it. They're talking about a new kind of IMF coin or Fed coin, the elimination of money, helicopter money. They're talking about the value of negative interest rates. These are all things out of desperation that they're going to try to do. So it's all coming. It's all coming soon. It's not 5 years away. I don't even think it's 3 years away. I think it's quarters away from starting. You look at that yield curve. We started the show with the yield curve. It's now 44 basis points. That's the narrowest spread it's ever been since 2007, just before the Great Recession and the global financial meltdown. So you're only 2 rate hikes away. You're going to get one in June for sure. You're probably going to get another one in the fall. That inverts the yield curve most likely. Maybe it'll take one more after that. So you're talking late 2018, early 2019. The yield curve inverts. The economy heads into the stock market starts to plunge. The economy heads into a recession, and it just perpetuates from there.
Michael, thank you very much for being on the X22 Report Spotlight.